Let's get a pulse check on the day with Fraser Macleod from Shaw and Partners. Hey, Fraser, thanks for joining us. What do you make of the day that was?
Oh, look, let's face facts. Some days are exciting in stock markets, and this afternoon was really
Well, you
dull
said
and
it.
boring.
Yeah,
I
not
said
me.
I said that to I said that to my colleague David Dahl just 2 minutes ago, and he agreed. Look, the market's slightly off today. Here's a positive that we have been saying to clients as well, is that the market's up. Market's up over the past 2 weeks. The market's up nearly 3 whole percentage points
Yeah.
now. Our Aussie market is usually fairly volatile in comparison to many global markets, but it's been a bit of a lifeboat, hasn't it? Really, over the past month or so. So from the previous high, or the previous most recent high that we would say would be significant as a measuring point, then our own market here in Australia is down 7%. Not too bad, especially if we compare it against the US market. So S&P's down 18%. That's nearly bear market territory. Nasdaq most certainly firmly in bear market territory. Nasdaq's down 28%, so nearly 30% decline of the tech-heavy index. We don't have the tech here, not in any great size anyway, and that's probably protected us. A lot of resources have protected us, and a lot of Aussie investors wouldn't really sell their financials anyway. So overall, US markets have been drowning, but our own market seems to be swimming, but still, swimming against the tide. So the tide is that, inflation rates, geopolitics to still be worried about as well. But with that, it's not been such a bad, has it? It's not been awful.
Yeah, no, I think perspective's everything as well. And to your point, if you look at even this week, which it feels as if there hasn't been any, sort of blockbuster day, we are still, well, we've just turned into negative territory after today. But, it was looking pretty good beforehand. Sure. So let's talk sectors, because we've had a lot of U.S. retailers report over the past couple of weeks. Walmart, Target, we know what happened in the wake of that. Nordstrom last night did really, really well. And that's an upmarket sort of department store. We're waiting for Costco, for the Gap. We get Dollar General tonight. A lot of people are trying to draw sort of lines between the U.S. retailers and what's happening here. Do you, or is the Australian story a different beast?
I think you have to, yes. So I think you have to take a bit of a guide from what's happening in the US. And obviously, what happened with Target was they were left with an awful lot of inventory. They couldn't sell it, and their costs went up enormously. And there's similar cost inflation which could be happening here, maybe not to the same extent. So say Aussie inflation by year end is going to be, say, maybe 5, maybe 6% if things get fairly bad. In the US, it's running at 8%. In the UK, it's running at 9%, and the Eurozone looks pretty horrible at 10%. So that is a slow pain. It's and then it's good that slow pain is then going to rear its head in results. So we don't really know. But if you want to be cautious, you probably would be staying away from retailers, even though they look that little bit cheap. When you compare PEs of, say, Woolworths, Metcash, Wesfarmers, they still look kind of pricey, I would say. So I would be cautious and not overextending in the big retailers here in domestic market.
South 32. How are you feeling about South 32 these days, Fraser?
Yeah, we still get love there. That remains our favorite large cap miner. So let's just, I don't know if you pull up a chart of South 32, but basically they were, not so long ago, they were $5.60 stock. They're now trading around about $4.60. They're probably worth $6. That's a big percentage rise on a 12-month target for us. Their net cash. Now, the reason that we like South 32 over, say, a BHP or Rio Tinto or Fortescue is that they're ex-iron ore. So this is not an iron ore portfolio. You're not really playing the danger of China directly slowing down. You're really more playing the EV batteries and also the energy side of South 32. So aluminium, met coal, nickel, silver, zinc is South 32's main commodities. And look, it does look cheap. It continues to look cheap over the past few weeks. We have been adding there. And I think probably most of the damage has already been done. $6 target is giving us a nice little room to grow over the course of the next few months. Yeah, sure, for sure.
Yeah, I wonder if that's how you feel about Goodman Group as well, because its share price is well off the highs. Doesn't seem to be catching up since it gave an operational update and really fell off. Really came off the boil there.
So it's perspective as well. So look, if you're holding Goodman Group, or if you're introducing it to your portfolio, it's not a trade. You're not going to be holding this for a few weeks or a few months. This is a longer term investment, adding to that weight again, portfolio investment trade rather than a short-term trade. So obviously these guys are industrial logistics specialists. It's still a 36 billion Aussie dollar market cap company. It's a monster. So they've got very diversified global exposure amongst industrial logistics. Really, you could say that they're the leader in their class. They've got plenty of pricing power. If you're worried about inflation, and then this is a company that has inflation-linked revenue, so these guys can cope with inflation coming on the horizon. They've got very, very long weighted average lease expiry. It's around about 5 years or nearly there, and an extremely high occupancy. It would take an awful lot to knock them in a lower class of economic environment. So yes, we like that one. It is bricks and mortar, but it's the right type of bricks and mortar as well, and you're probably getting it significantly cheaper. Pull up a year's chart, looks a bit sick. Pull up a 10-year chart, and you really see where that stock's going in the long term.